Mortgage financing plays a pivotal role in the world of residential real estate. It's the engine that powers the purchase, new construction development of properties. At the heart of this financial landscape are two main types: public and private financing. Public financing often offered by banks and credit unions, and private financing typically provided by individuals or private entities. Each has its unique advantages and considerations. Understanding these two types of financing could be the key to your next successful real estate purchase or investment. Public financing is a popular choice among many real estate enthusiasts. It's a type of mortgage financing that's backed by the government. This backing reduces the risk for lenders, allowing them to offer lower interest rates to borrowers. So, what's the catch? Well, public financing usually comes with strict eligibility criteria. You may need to meet certain income levels, credit scores, and even use the property as your primary residence. One common example of public financing is the Federal Housing Administration, or FHA loans. These are designed to help lower-income individuals become homeowners, and typically require a down payment as low as 3.5% of the purchase price. There's also the Veterans Affairs, or VA loans, which are exclusive to military service members, veterans, and some surviving spouses. These are just two examples, but there are several other public financing programs out there, each with its own unique advantages and requirements, including down payment. While public financing may seem like an attractive option, it's not without its limitations. On the other hand, private financing offers a more flexible, albeit riskier route to real estate financing. In essence, private financing is a form of lending that's backed not by government entities, but by private institutions or individuals. This type of financing often comes with higher interest, reflecting the greater risk taken on by the lender. But where it shines is in its flexible eligibility criteria and down payment terms. Traditional lenders who may reject applications based on stringent requirements, private lenders often look beyond credit scores and delve into the potential of the investment itself. For instance, private lenders may require a down payment of 20% or more of the purchase price, providing a different avenue for those who can meet such terms. Two common types of private financing are hard money loans and bridge loans. Hard money loans are typically short-term, high-interest loans based on the value of the property, not the borrower's creditworthiness. Bridge loans, on the other hand, are temporary loans that bridge the gap between the sale of one property and the purchase of another. Private financing, with its unique down requirements and flexibility, could be a game-changer for those who can manage its risks. Now that we've introduced public and private mortgage financing, it's time to put them head-to-head. Public mortgage financing, often backed by government agencies, provides a sense of security with typically lower interest rates. It's a great option for first-time homebuyers or those with lower income, thanks to lenient eligibility criteria. However, this type of financing may involve a more rigorous approval process and strict guidelines on property types and uses. On the flip side, private mortgage financing, provided by non-institutional lenders, is known for its flexibility. If you're looking to finance a unique property or need funds quickly, private financing may be your go-to. It often has less stringent requirements and faster approval times, but remember, with this freedom comes higher interest rates and potential risk. Private lenders are not subject to the same regulations as public ones, so it's crucial to do your due diligence. So, how do you decide between the two? It comes down to your individual circumstances. Public financing can be a safe bet for those who meet the criteria and aren't in a rush. Private financing, while potentially riskier, can provide the flexibility and speed that some property buyers need. Comparing the two, public financing is like a sturdy, reliable sedan, while private financing is more like a speedy, sleek sports car. Both have their place on the road, but which one you choose depends on where you're headed. It's clear that both public and private financing have their own strengths and weaknesses. Choosing between public and private mortgage financing is not a one-size-fits-all decision. It's a choice that should be made with careful consideration of your own unique circumstances and goals. So, where should you start? Well, it's essential to do your homework. Dive into the nitty-gritty of each financing option. Understand the potential benefits and drawbacks, the terms and conditions, the interest rates, and the repayment plans. Look beyond the surface details, and don't hesitate to ask questions, lots of questions, until you have a clear picture. Moreover, consulting with a financial mortgage advisor can be incredibly helpful. They can guide you, provide personalized advice, and help you navigate the sea of information. They can also help you evaluate your financial situation and align it with your real estate goals. Remember, The best mortgage financing option is the one that aligns with your real estate goals and financial situation. So explore, learn more, and make informed choices.